Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. One of the retail businesses that's held up really well as a lot of online players have grown is a company like Dick's Sporting Goods. When you're buying sporting goods, a lot of times you want to feel it, test it out, compare brands. And the company has really leaned into that with a lot of its locations, improving their experience, giving you the ability to try out more equipment. And that's done really well. Now, the company's growth has slowed. So today I want to dig into exactly what's going on with the results and then what investors are getting, because I think this is a company that we need to think about as more of a value stock than anything else right now. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And if you like this video, check out my newsletter, Asymmetric Investing, in the show notes. And I'll start with a quick look at second quarter earnings. This is a high-level look at second quarter results. You can see that sales were up 3.6%, so not a big number, but there was 1.8% growth on a comparable same-store level. Now, a lot of retailers, particularly in the second quarter, were reporting a slight decline in same-store results. So this is actually pretty good. If we go down to some of their operating metrics, you can see that that slight increase in sales was offset by higher costs. So net income was actually down pretty sharply, 23%, and earnings per share were down the same. Like a lot of companies, we're also seeing a little bit of pressure on both margins and operating costs. So this line right here is the gross margin line, and it goes right to left. So you can see that margins were down slightly, 34% versus 36% a year ago. And then operating costs, the number to watch is the selling, general, and administrative expenses went from 21% to 24%. So that was a pretty sharp increase, but that's the cost of living increases that you're giving to employees, added expenses as companies are kind of getting more back to more normal operations. So not a huge surprise there, but that's the reason that net income was down. What I want to do today, though, is take these results and put them in the context of a longer term picture for Dick's. A few charts I'm going to show here, but this is the 10-year revenue chart. And you can see that revenue growth has been really consistent over the last 10 years, more than doubling. So this just shows the momentum behind the business. This is a combination of opening new stores and then growing stores at existing facilities. Net income, you can see, is a little bit more lumpy. During the pandemic, results were really good. I'll get to one of the reasons behind that. But you can see that we may be at an abnormally high level of net income for Dick's, at least compared to what they have done historically, which was pretty consistent. Like I said, one of the reasons for higher net income was actually higher gross profit. So their profit margin actually jumped sharply during the pandemic, or at least after the pandemic was kind of wearing on for a while. So it went from 28% in May of 2020 to a peak of 38% in January of 2022. So a really sharp increase. Now we're now going back to maybe more of a normal level. But one of the things that I think we're seeing here is a lot of competition coming into the market. There was consolidation. There was online stores taking sales. There was reconfiguring of the retail stores that Dick's had and rethinking some of those over the last few years. So margins were coming down that entire time. But we have now gone back to a point where hopefully Dick's will be able to generate a little bit higher profit margin going forward, because you can see that right now that is going straight to the bottom line. Now, what I think is intriguing about the stock is it's not all that expensive if we keep these high margin levels. If we start to see margins go back to 28% like they were in early 2020, that's not particularly interesting to me. But if we maintain margins in that mid 34% range, the stock is actually pretty reasonably priced. This is the valuation set. This is the valuation metrics here. Price to earnings multiple on a last 12-month basis, 9.9. On a next 12-month basis, 9.2. Enterprise value to sales is under 1. So that's pretty solid for a retailer. Pretty decent balance sheet. There's $1.9 billion in cash, $4.3 billion in total debt. There's also inventory. So that's one of the things that a lot of retailers use debt for, is to buy inventory. And then the other thing I want to show is this chart, which is Dick's shares outstanding. You can see that over the last decade, Dick's has been buying back stock at a regular rate that has slowed down a little bit the last couple of years. But I think we will likely see that continue. And that's another reason to be bullish on the stock. What I think we're seeing in this space in retail specifically is that margins are probably going to maintain at a relatively high level because Dick's has really consolidated a lot of the power in the sporting goods market. And then it's built out those facilities where you're able to go try products, get a great experience. And that's something that's really difficult to compete with. It takes a lot of capital to build out a retail store like that. So that period where Dick's was buying up competitors and there was a lot of consolidation in the industry, that's really working to the company's advantage now. What we want to look for is, do those margins, particularly gross margins, stay at an elevated level? I want to see those in the mid 30% range, because if they fall into the mid to high 20%, then a lot of your net income is going to evaporate. Also need to maintain operating costs. But there is a little bit of slack built in for investors because we are getting a pretty good value. Price to earnings multiple under 10. I think this makes it a really good value. And the fact that same store sales are growing slightly, as a lot of other retail competitors are seeing sales fall on a same-store basis, is really a good sign. Dick's is not a stock that I own, but definitely one I'm going to put on my watch list because it's got a little bit of growth, it's got value, and companies buying back shares long-term, all trends that I really like. But what do you think about Dick's Sporting Goods? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. And thanks for watching, everybody. See you here next time.